Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, September 20th, 2024. It is 11:22 Eastern Time as I'm starting the video. And here's what we'll do in this one. I'll do it backwards. I do want to definitely get to the equity markets. I usually cover those up front. And what I'm going to do is just to make sure, because sometimes that gets the trade ideas get pushed to the side. So I wanted to get just a quick overview of the utility sector, since I threw that out as a trade idea. This one being aggressive, sometimes if my confidence is high enough of an imminent breakdown, I'll go ahead and start a short position. And then, as I said in that post, you can either an and/or situation. You want to play it safe. You wait for a break of this is the conventional entry, a break of the trend line, the wedge. There are absolutely zero sell signals right now on the utility sector, but I do think that it's coming, and it tends to move pretty fast when you get them. What I'm going to do here is just show you some of the top utility stocks. And again, start a position here with an add-on there, or wait for the break for a conventional entry, and then you have the targets right there. Just show you the top few here in the sector. I always sort my watch list of the component list. And these are the components of XLU, the utility sector. Remember, the utilities don't have a big bearing. It's one of the smaller weighted sectors in the S&P. So we're not trading the S&P. At least I'm not. This is just a sector to get in front of. And so these breakdowns appear imminent and likely, and some have already broken down. So there's NE, and that's one of the top. That one's a $173 billion market cap company. SO, the Southern Company, right here. There's your divergence building, very nice clean trend line. And again, when these guys go, like any stock, first of all, there's no guarantee any breakdown will stick, but sometimes you have a little snapback rally, and sometimes you don't. Either way, when the herd shifts, especially on a crowded rush to an exit, I see in a lot of these stocks in the sector what appears to be a near-term buying climax, at least a near-term, possibly a permanent buying climax. So there it is. I just want to show you all these if you want to replicate it. See, here's the third largest, Duke. Duke broke down yesterday, sell signal, a little kickback rally, still below the bearish rising wedge. CEG had a pop up today. Saw that rising in pre-market when I was checking it out, so I wanted to wait to the open to get it out to you, so we could factor that into the price. Plus, I usually wait till the market's open to get trade ideas out to you, unless it's something that I think is going to reverse in pre-market. But that put in a big divergent high, and that's probably a top. And so what you want to look for on this one, again, this is the fourth largest. This is a $63 billion company, Constellation Energy. Ideally, you don't have to get it, but what you want to look for, any gap down, whether we have a few days where it holds up and you can put in an island cluster, or just a gap down. And then, and I'll get to this with SPY in a second. We have an island cluster top so far today in SPY. I'll get to that towards the end. And the strategy is just like the bearish engulfing candles. We've had quite a few of those recently, including a couple trades yesterday, which I'll try to get to. It's super simple. It's one of the best trades out there. Now, we don't have the island cluster top or reversal yet. Again, we need to have a gap on the other side of this candle. We have a gap today, and whether we put in no more candles, this is the only candle today, or we put in a few more, then gap down to get an island cluster, that would be it. And then when you get that, so when you get the other gap down, if you put a stop just above the highs, because the nature of an island cluster top, just like a bearish engulfing, can't be violated. And even better, if you get a gap down, let's just say hypothetically tomorrow we gap down, let's just draw it bigger, let's just say it comes out with a bang and we go down here, then you have there's your gap, and there's the bottom of that candle. You can even have a stop just above, a little bit above. I give it a little room. They being the nefarious forces in the market, the powers that be, market makers, algos, give it a little room, but you can even have a stop if you want below the top, because you really shouldn't violate. Usually you don't take that gap out, that second gap that solidifies it. So anywho, I'm just showing you kind of an overview of the sector and the fact that several have broken down, which was a reason why I believe the breakdown in those that have the remaining that have bearish engulfing or bearish rising wedges or other bearish chart patterns are likely to follow suit soon. And so there it is. So some, not all, as you can see. And I don't have every chart marked up, but here's PG, PCG, Pacific Gas and Electric, just walking up the uptrend line. Looks to be a likely buying climax right there. You can see this big surge in volume with a near vertical rip. That's indicative of a buying climax. We had a vertical rip there, but it wasn't really confirmed with volume. In a buying or selling climax, you want to see a big surge in volume. And I think we had that in XLU. I think I showed you. I know I showed it. Oh, it was on the chart of SDP, which is the inverse ETF. My volume bars are turned down, but for you, I will turn them up. Where is it? Volume right here. Edit. Turn these up so you can see them. Okay, so that's it. So you see this near vertical surge. That's also, remember, SDP is inverse. So that's utilities plunging into their lows. And you can see that spike in volume that accompanied it. That's a buying climax. And this appears to be, you can see down here, I have it circled, a selling climax. Huge surge in volume, which is, again, it's inverse to the utilities ETF, TJU. No, that's the sector itself. XLU being the ETF. So there's your spike in volume on this recent near vertical surge up there. There's your selling climax, which I circled in there. There was a near-term buying climax that didn't prove to be the end, but again, you know, you miss 100% of the shots never taken. That's all you can do in this stuff. And look, when you get it, you know, stops. All right, I gave you suggested stops. Those are based on really T2, which right now is kind of the sweet spot, what I call my preferred target, because you have a uptrend line coming in with nice price support as well. If that trend line breaks, then yeah, T3 is the next one, and I will most likely add additional targets. So that's your update on the utilities. I'm not going to go through each and every one because, again, you just look at the top ones, and that kind of gives you an idea of where the sector might be going. And believe me, I do look at all of them. I'm just not going to waste your time in this video. Okay, and quick updates on those that had we shorted yesterday. Nice bearish engulfing candles. Again, those stops were drawn in on using the drawing software, the screen capture software. But we're now at right down to that T1S1, so we're already profitable. Remember, I named it, as I told you yesterday, T1S1. Really, it's first support. That's, to me, it's not enough profit to get out of it. And they're nice bearish engulfing. These are topping sticks. This is not a day traders or a one-day swing trade. It's the top is what I'm looking at potentially. And again, if wrong, you can keep a very tight stop right above the bearish engulfing, yesterday's candle, because if we go above there, it doesn't guarantee anything like that we can't do this and then go down. It just says that this is no longer a topping stick. That, again, the bearish engulfing that came after that previous one engulfed the body. And that's it. So we're hit there, and surprise, surprise, we hit that level and bounced today. We had a low of 1852. I had the line at 1849, close enough for government work. One little last hurrah, whether we bounce for a week, a month, 2-3 months, as long as we don't violate that, the next sell signal comes below, break below that 1850-ish support right there. And that should open the door. What were the other ones I gave you? UWMC. So all of these are profitable today, not by much, but more importantly, I like to see that. I really like to see, after bearish engulfing candles, follow through to the downside. All the best if you can get it the following day. It's not necessary. Sometimes you go a little sideways, but the further you get away from there, the more obvious it becomes, and the more it helps to solidify that sell signal. So that's your update on those guys. NG, natural gas, not much to add, and it's just following through yesterday, so we're probably up 4 or 5% since our entry or re-entry or add-on or whatever you want to call it yesterday. This is a trade that I frequently update and micromanage. UNG, of course, being the ETF or ETN. They call it here ETF. It always used to be an ETN. I don't know why maybe it's a charting program sometimes wrong. Doesn't matter. You got to look it up, see if they give you a K1. Boom, that was it. So yesterday, yeah, we're up about 5% from yesterday. And again, there's big resistance right there. It needs a break. Treasury bonds, my thoughts on Treasury bonds, and I think that's one reason. Again, I'm a very, how do you say it? I kind of web in a lot of different things. Look at kind of everything out there, and there are tangential kind of connections to trades, and this is one of them. those mortgage lenders that everybody figured, oh my God, mortgage rates are going to come down, we're going to cut. And now, of course, I've seen the headlines, articles, hey, what happened? We got a 50 basis point cut, yet mortgage rates actually went up. And again, number one, as I said, it was priced into it. You have to ask yourself. Remember, there was a much higher, twice the odds, twice the chance of getting a 50 basis point than a 25 yesterday. So how much of that's been priced in? Well, so far it looks like, at least on the long bond, all of it. Plus, that's inflationary. Powell's resorting back to his dovish ways. Scorpion does what he does. And, he tried to put on his bull mask or bull face as long as he could, and then he just couldn't take it anymore. The guy probably couldn't sleep at night. So he's returned back to his easy money ways, even though by, articles I read a lot said, look, to save the economy, yeah, I do think, get in front of it, but they usually never do that. This time around, he's cutting rates, and he's cutting them more aggressively. I'm going to talk on that, the 50 basis point here in a second. Either way, let's not make too much of it. I just want to mention that so far so good. We have now taken out T1, not by a lot, but the further we get away from there, we should begin to start snowballing once it's clear that level's been taken out. And ZB, same thing. We need to take out the lows. There's a little potential downtrend line if you want to run tight stops, but I'd give it a little room. I'm viewing this again as a swing trade, not just an active trade. So, our entry was right here on the break of this initial trend line right there. Breakdown back test, ever so slight marginal new high, nothing even close enough to come close to any reasonable stop to any of these targets. So still very much an active trade, and it can do whatever it wants to, as long as we don't. Again, your stops on this one, I'm starting because people giving me feedback. I used to always list suggested stops, but then it got complicated because I have multiple targets, and I have to say that the person targeting T4 or even more isn't going to have the same stop as a person targeting T1. So I typically say set your stops commensurate with your price target or targets. What does that mean? Some people make a hard, I'm going for T2, I'm going to sell or close out the entire short there. Others will say when T2 is hit, I'm going to take, or T1's hit, I'm going to take a 25% profit. T2, another 25. T3, another 25. And then the last quarter of my position, I'll close out at T4. So there's 101 ways to skin a cat. I think that's how they say it. And there's just 101 ways to, trade. And at the end of the day, it's a losing strategy if you don't have a favorable risk-reward ratio, be it 2-to-1, 3-to-1, 4-to-1. The higher your success rate is on a trade, and that's what I'll vary too. Some trades, I could stick with impunity. I have a much higher track record than others because some securities trade better to the technicals or my style. Those I can use a lower RR 2-to-1, and again, it depends on the security. Whereas other ones I'll use sometimes, and I'll talk about that. Like, for example, these, the trades we did yesterday with the bearish engulfing candles. Or let me roll into the stock market. I'll give you one right now. So yesterday, let me go to start with QQQ. So yesterday I told you QQQ hit, this is a big level for me, has been, still is, about 485.68 was that previous high, which was also a divergent high. We hit it again yesterday, and I said you could short there with a stop somewhat above, and either game a pullback, again, wherever you think things are going. You can see the level. This is a good level. They'll step in and buy 477.72. It's probably going to contain, at least produce a reaction, a tradable bounce. It could be the end, but I think it'll get it. They'll buy that. Pavlov's dogs will buy that level. It's right about, we're pretty much hit it today, and then gave them a little bounce. Then once we break it, now if we do, here's the thing, guys. So any short trade made there yesterday. Or if you're still holding on, just riding out this, viewing this to be a false breakout, which I believe it will be. You have my upper, kind of, this is where things start to change if and when they take out that gap right here, that big old gap from right off the highs, bearish engulfing candle. So there's a lot of evidence still very much in place that a top was put in and nothing's changed my outlook there. Now, the $1 million question is that it for is this going to be a one-day wonder, the breakout? So far we're only down. We were down about 1%. We're down about 0.65. You can see on the Qs. It's the first support level where they should buy and did buy. But now if that gets taken out, you're going to start to get that rut row moment from the bulls. So all those that bought that, because number one, this breakout occurred on a gap. That was Wednesday's close. That was Wednesday's open right here. So, only futures traders or people trading in pre-market, which is a relatively small amount. How do you know? You can look at the volume price histogram. You can just see that, when you zoom in here, the vast majority of folks chased that rally and they bought here. You could see the volume price histogram bars are thick out to here. This is a big thin zone. So now they're underwater. We've entered that thin zone, and this is now resistance right there. If you're using, because I will use these quite often as, they're tools, as support and resistance levels to help identify targets. Again, the volume price histogram bars. So you see, this is where almost everybody bought yesterday in this area. Nobody bought in a gap, technically, at least not showing these regular session trades. Again, futures traders, yes. Those that might have bought in pre-market, yes, but in the regular session, that was the gap. That's why you have this big thin zone. So this is where this was Fed day. And so either way, bulls need to see and want to see this level regained, and especially yesterday's highs get taken out because that was the resistance on the 60. However, the ideal scenario, especially for the bearish case, you get a little bit of a downtrend line going here. Maybe we come up about that high, get another downtrend line right here, potentially where we're at in the bottom of the thin zone. So this would really help the bearish case. And again, you can look at it glass half full, glass empty. I mentioned it yesterday. If you're bullish, you can buy a back test of the trend line. But remember, by doing that, by coming in to back test the downtrend line, you're going to have wiped out everybody that bought, and there's a lot of institutions in there too that bought the 50 basis point rate cut. So pretty much in summary, bulls are holding the line. They need to ramp it back up. They need to not have this happen. And look, again, take your outlook on the market, your view. It will just be, if you want to not you don't want to overcomplicate things. That is a very well-defined downtrend line. There's a very clear and obvious and impulsive breakout. Back test is objective. It's also backfill. You have the gap. Well, you have a lot of candles there. Anything in here is still, you could still make a decent bullish case. I do what I call micro analysis, very short term, looking at those that bought the thing getting wiped out. And again, it meshes with my longer term outlook that whether this was the end of the rally or we go up here, that's what, my prediction has been and remains. And especially since we got the 50 basis point, I expected them to buy that. And I'm going to talk on that 50 basis point here in just a second. But again, if they come back in and back test it, which eventually I do think this trend line fails, and then you have an uptrend line here, a little triangle pattern, and then my line longer term. We start taking out the big levels to watch. If you guys want to keep this very simple, there are no guarantees. The downtrend line, if that's lost, and really it's going to come in right around the where we closed Wednesday after the Fed meeting. That's the bottom of the red candle. It's also price support there, 471. So you can set a price alert at 471, price alert on the trend line. You see that go, that's pretty dang bearish. Otherwise, like I said, if you're bullish and we are going to new highs, it's going to be an objective level to buy. And right now the odds, the bulls are in control, because as I like to say, a breakout is a breakout unless it fails. And so that's it. So you can buy there, whether you're bullish or just market agnostic and you want to just trade the technicals. Like you just covered or short or went long on the breakout of yesterday when we saw the futures going up. They started to go up on Wednesday evening. We're going up, and that's where we took out that high where I suggested as a stop. That was Wednesday's high right there. Okay, and then so if we break the trend line, and 471, that's quite bearish. I'm going to put an alert there now just for fun. I'll be watching it, of course. And then kind of not 100% lights out, but a big black eye to the market if we take out this uptrend line. And again, they'll most likely buy the initial pullback, then this level here. So those are your three big levels, 471 and or the intersecting downtrend line, the uptrend line right there off the lows, the August 5th lows, and then this big major reaction low right there, 448.72. That's also, we went long both of those two lows, and that's it. Boom. And then that one goes, I wouldn't even worry about that one. Traders are going to talk about it if we get there, but I think I wouldn't try to buy that one. This one, these are the ones I'll probably give a bounce if we hit. And look, we can do this. And then all this that I just talked about is moot. So I'm laying out what to watch when we get there, because remember, these things, especially if it's a failed breakout, if we get a false breakout and this thing fails, things are going to happen quick. There's going to be a fast unwinding of positions. I can't get updates out to you that quick. So you got to have a trading plan, how you're going to trade it, what you're going to do. If you're bullish, here was a nice pullback today. You had an opportunity to get in at about half, a much better price than yesterday where we gapped up because we took out the gap. That was nice support. And if you're bullish, you have another, if we get down here, to buy it. But you've got to also realize which levels are going to change things and where you might want to stop out. Likewise, if you're bearish, you got to make your shorts strategically. Short resistance, and then start shorting breakdowns of support at this point. Okay, now let's look at SPY. So in the last few months, including but not limited to the tops in QQQ, SOX Semiconductor Index, the NVIDIA, probably the most important stock I've highlighted, and we've shorted bearish engulfing candles. All of those proved to be very profitable. And the strategy is so simple. It's one of my favorites. So that is just one of many types of candlestick reversal patterns. You also have in SPY yesterday, so far as of right now, what we call an island cluster top reversal pattern, and it's kind of similar. Number one, island tops. I'm sorry, not an island cluster. An island cluster top is if you have more than one candle separated by gaps on both sides. Right now, this is what we call an island top, a single candle. It's a nice little doji as well. Dojis are indecision candles where you open, you close about where you open, you go higher or lower through the day, and they're known as indecision candles. And is that an evening star doji? I'm going to show you some resources to check that in a second. But either way, just like a bearish engulfing, it's super simple. So number one, let's just take it back a step. So before the Fed meeting, I said, and there were still, remember, we were a couple weeks back, 25 basis points was priced in. That was the favor. Just in the last, week or so leading up to the meeting, the odds tilted and then went to as strong as a 65-35 split, or about 2/3 chance we'd get a 50 basis points, and only a 1/3 chance, or less than half, that we'd get the 25. Early in the Fed day, we actually went almost back to even, but by the end of the day, before the announcement, it went back up. So, and as I said, my expectation, if we got 25, the market would throw a hissy fit and go down. If we got 50, it would rally. And SPY, which had never made it to the top of my market top range or closer to it, which would have been better for Fibonacci alignment on my targets, I said SPY would most likely, I would suspect, would make a new high and get in the top half of the range there, maybe all the way to the top. And I gave you, max to the top, and that would bring QQQ in the bottom third. Well, we made it into the top half of the range. SPY made a new high as predicted on 50 basis points. It could still make a, from where we're at now, or really from yesterday's highs, it could go up another 1.7% to the top of my range. And then remember, this was a call on a market top, not in time, but in price. It's a range in price. There's never had a time element to it. So if we go up there, then it's still a correct call. Anything much above that is an incorrect call, just wrong. That is like I said, in the upper half of the range there. And we have whether it pans out or not. And again, can't impress the beauty of these type of trades is the risk reward ratio is phenomenal. If it does prove to be, as so far the bearish engulfings proved to be, topping sticks in NVIDIA, QQQ, and SOX, If it proves to be that, then it's a top for a trend. It's not a short-term sell signal. It's a top to the trend that started back in October 2022, and then a new bear trend begins, and we go down to my targets here. In other words, to put it in mathematical terms, we drop as much as 40% and probably more. Again, I'll increase that target there. So you have about a 40% profit potential to my maximum target. And if right now we're still, because this wasn't an island top yesterday. It's only an island top today, and it may not be if we seal that gap up today, right? We gap down. So, if you want to just put a stop above the top of it, then you're talking not even 1%. So you have 1% chance of loss. Now, personally, I wouldn't put too much into it. First of all, the day hasn't even closed yet. We don't even have it. It's early in the day. So if it was 3:50 p.m., 3:55 right now, I'd say, yeah, you're going to get it. So let's just I'll loop back to it and we'll see. But I still have, again, this is the top of my bounce target zone. So if you look at it this way, and if you're swinging, you're playing the long game, you're going for these targets, then you're talking now, you're talking about a 2.5% upside. So a stop somewhere above there, not too far, to make, 40 something percent. That's a phenomenal risk reward ratio. All right. So that's SPY. Resources for candlestick patterns. One of the good ones I've had this bookmark for years. It's called thepatternSite.com is a URL. Bukowski's Candlestick Alphabet. You can see candlestick patterns alphabetically. So if you wanted to look at, what did I just say? We have a potential island top. So you go down to I. It should be in here somewhere. It's funny. I don't see it here, but I know he has it on here. So you can go to visuals. I usually go to the visual chart patterns, which is right here, candlestick visual index. And then you go down here, and you should have island top somewhere in there. Okay, somewhere on there is the island tops. And here's what you can potentially have on SPY right now, evening doji star. Another great resource that I use regularly or have in the past and recommend. People always ask, good learning resource. Is the chart school at stockcharts.com. It's free. You don't even have to have, that's my knowledge, I never did. You don't have to have an account there with them. I do have an account with Stock Charts. They have some good charts, and I have many different charting platforms I subscribe to. But this one, it's just really, really nice. And when I first got into technical analysis, I was self-taught. This was one of the resources I actually back in the day printed out a giant notebook I still have somewhere of all the whole chart school. But it's easy to access online, and just go through it in order, take your time, read a chapter a night. It's just simple, and it's not overwhelming, and you can go at your own pace. But then they have different sections here. So you go into chart analysis, chart types, and then you read all about candlestick charts somewhere you have here. Candle volume and introduction to candlestick charts and candlestick reversal patterns, bearish reversal patterns. You go in there and you can see the different types of patterns, like an evening star and other things that you're looking at. So anyway, something worth checking out. And let me get back to that. So that's what we have in SPY right now. And only time will tell if it pans out. But the first check mark you get, this is how these things work, would be to see a nice red close today. Especially we get we pretty much build on today's losses or stay here, just not come back up there and violate that candle. And then it's like to say the redder the better after that. And I kind of went over what will happen, on a very short-term basis if we start to fall much lower. There's the bottom of, or right here is the bottom of yesterday's gap, where everybody that bought the 50 basis point hike will be wiped out. So we'll see, and those are just developments to watch for. But let's talk a little bit more about that. Okay, so this subscriber here was nice enough, as I asked if anybody was interested in doing this, put together a chart based on Forbes federal fund rate history going back to 1990. plotted rate changes. It says greater than 50. I'm assuming 50 or greater, because the one that we just got was 50, and that's included. So these are 50 basis point hikes and cuts, green and red lines, and pretty much, it's there. I'm assuming, this is accurate. It looks like they took a lot of time to do it. Again, thank you very much. And these are your rate hikes. Things were getting hot. And these are the red lines are your 50 basis point cuts. Again, that's what I'm assuming that is. Let me just make sure I read that correct. Yeah, green lines are increases, 50 or more, and red are the 50 more cuts. So, again, you can just see and I replied, I've been doing, this for a while. I've been, even before I was into technical analysis, charting, I was into fundamental analysis, my background being a business major, stockbroker, former career stockbroker, started at Merrill Lynch, very extensive training on fundamental analysis. And we all know that generally rate cuts are bullish because lower cost of capital spurs economic growth, also drives. But in the Fed's preferred method has always been to move in quarter point increments. Although over the years they've done quite a few 50 or more basis point. 50 is pretty extreme, and you can see again they come only, or I should say, usually. Again, everything is about probabilities, not possibilities. When you're trading, you're looking at analysis. They typically come. That one came right around the top. There was maybe a little hurrah left in there. That was the last bear market. This was the bear market in 2001 to 2002. The dot-com bubble peaked in May of 2000, ended in 2002. That was a Great Recession, 55% drop. By the way, the NASDAQ dropped 78% back then. And the NASDAQ and the S&P fell about 56% in 08. And you can see, again, look where the 50 basis point cuts are associated. There was COVID, emergency situation. There was last time we started hiking in quarter point increments to curtail inflation, nice steady rise, and now here's the 50. So again, this chart speaks for itself, and let me show you my comments that I made to that. It would certainly appear that way. That thanks for taking the time to mark it up. To the best of my recollection, again, there might be some outliers, but 50 basis point cuts in recent history have been associated with times of market and or economic duress. And so I went on to do this. This kind of jogs something I've had in there, and I'm surprised I still have these. So back just before the Great Recession and the start of one of the worst bear markets in history, which I clearly saw coming. I can show you some documentation there on that. I took some screenshots from some of the threads on a swing trading site I was subscribing to at the time, as I knew we were on the verge of a major historical event. And at that time, there was only one person, even the two folks running the site, which now I don't believe is there anymore. Some years back, I looked after leaving that, canceled that service after. They were just permanently bullish, buying every dip well into 2008. And I even have all that documented because I screenshot a lot of those posts. And then they went on to claim that they called the top in the bull market in 2007. There was only me and one other guy on there, and he called it a secret indicator, and he wouldn't tell anyone what it was based on bonds, that he could see the same thing coming I saw in either way. So, and these guys are just, but here's what I wanted to mention. Here's what I cited back then. So I posted this again. I saw, just the writing on the wall for not a correction, not a bear market, but one of the worst bear markets and recessions that we would see since the Great Depression. That's all written in here and documented, and that's back off. So anyways, I'll go on. I'll just read it quickly. I'm surprised to see so many believers in the fact this bull is most likely seen its best days. By the way, that was in November of 2007. That's right around the top. I think the official top was late October. To avoid the risk of sounding like a Monday morning quarterback, I'll include a post that I made here nearly 3 months ago. I'd like to expand on my third point below, consumer spending. Guys, I'm reading this because this all plays in now, by the way. There are a lot of similarities. There are quite a bit of differences, I will acknowledge that, but there are also a lot of similarities to back then. So, the fact that the first pillar, consumer spending, inflated housing values, has now collapsed. I'm going to just stop here and an ad that I've showed you peaks, things that I'm watching in Zillow Trends. It hasn't collapsed, but it has certainly, the housing market has peaked by most of the metrics I follow. The next big pillar is at risk going, which is the stock market. Okay, so the way this works is, and again, I'm pausing here and just kind of showing what happened back then. Consumer confidence, the two biggest asset classes, things that make consumer confidence is a coincident indicator, has no predictive value. When the stock market goes up and the housing market goes up, consumer confidence goes up because you're rich. You're rich on paper, right? Your 401k is up, your Nvidia stock is up, your trading account is up, your house is up, and you spend money. And you think it's going to last forever. At least at that point, it's there, and you look at your Zillow value in your house. So, when the housing market starts to then roll, and again, I'm not going to get in. I've covered that in recent videos. I'll continue to update that. But by most metrics I'm looking at, it has peaked. We're seeing days on market going up, price drops going up, everything else. It mirrors. I was watching this very closely back then in 2006, 7, and 8. So then the next big pillar is the stock market. Because once housing market usually peaks out, and then you'll start to get consumer confidence and every other indicator. So unless this market somehow manages to pull a rabbit out of its hat here, the nail will have been put in the coffin as Joe Consumer sees his or 401k and life savings at Merrill and Schwab drop 20+%. If this happens, you will see the consumer shut down and the economy hit the skids, meaning consumer spending, which is 2/3 of GDP. Right? I'm stopping here again, reading, going my sidebar. Consumer tightens a belt, and then GDP, which is 2/3 of consumer spending, over 2/3, then goes down. If that happens, the final pillar, personal income crumbles as well, and we won't be in a recession anymore. And saying I won't say the D word, depression, because everybody was foaming at the mouth bullish back then. So that's it. So, and here's the quote. I'm sorry to all that segue into there, but again, it's the parallels are there. So on August 20th, just about 2 months before the stock market embarked on one of the greatest bear markets in history and what was now known as the Great Recession, I put this post here, and I said, I remember reading a quote years ago from the late great J.P. Morgan that said something like, anyone who bets against the U.S. economy is destined to go broke. And then I went on to say, well, I'd say anyone betting on the U.S. economy over the next year will. And they obviously certainly did. We know what happened in 2008. I am a simple man, but I think everyone can agree that the three biggest drivers of the market economy in recent years were excess liquidity, check, gone. We know the Fed's been subtracting liquidity. So it's not 100%. It's been, yes, tapering down. You could look at M2, a lot of things. Unusually high M&A activity and private equity buyouts, gone. Okay, if you read the headlines, M&A, private equity has just been plunging. Private equity deals, M&A deals have been certainly rolling over. And then number 3, the number one largest contributor to GDP, consumer spending, soon to be hampered to severely hampered. And so I said, I just don't see how one could remain bullish on the outlook at the markets at this point, in my humble opinion. That wasn't I had it in here somewhere, my 50 basis point. Oh, here we go. Okay. So then went on, and everybody's just saying, no, you're crazy. The Fed's going to keep the market going up. Don't fight the Fed. All that stuff is by everybody on here. And then I went on to reply to someone, I think it was a don't fight the Fed comment. Fed's coming to the rescue. I said, I only invest on long-term fundamentals, which at this point, which this previous post was based on. And I trade the technicals. Okay, so that's important. I've been saying this. This is what I was saying. What was it? Almost 20, close to 20 years ago. And the same thing I've been telling you guys lately. I trade on the technicals. I invest on long-term fundamentals. Those are longer-term positions, and it also affects my longer-term outlook. And my trading, at this point, I'm even more honed in on the technicals now on those long-term positions. So case in point, in my IRAs, I have a substantial position in October 2008 SPY puts that I scaled into from September 26th to October 10th. And that's because I feel strongly I'm correct here. The thing is that fundamentals almost always take longer to play out than one expects, right? If we hold that blah, 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 the 1410 to 430 level, and we rally into year end, I'll be right there with you on the long side of my trading account. All right, so a lot of you, and the trolls have been quiet lately, but they just don't understand that I speak and I continue to speak. The charts are pointing in one direction, the fundamentals are pointing in one direction, but those things take a while to play out, and it doesn't affect how I'm positioned. I'll be in and out. I may get in short. I may believe that's the start of the next big leg down, but then something like August 5th, for example, happens, although targets were hit, and then I go the other way. And then I'll, when time's right, which I think we're at now, scaling back in, then for the next leg down. So went on to say, and you can click on that post, read it here. In my IRAs, I will continue to scale into long-term puts unless I see the fundamental outlook improve, which, my God, we all know it did not in 2008. One more thing that may help those on the board here who believes in the PPT. That's what we call the plunge protection team. You can Google search that and read about it. Conspiracy theories, Santa, etc. Rate cuts don't work when the Fed is clearly behind the curve. Case in point is this post I made back in another blog on article I read in the journal, right? So I made this post right around that time. At an unscheduled meeting on January 3rd, 2021, the Fed cut rates by 50 basis points, 0.5%. Remember, that's unusual. The NASDAQ had its best day ever in history, rising 14.2%. Rah, rah, right? Think yesterday, but on a smaller scale, right? Because that back then, that was the NASDAQ bubble was in full swing. That was like kind of like just NVIDIA, but on steroids. The NASDAQ fell 57% after that first rate cut. Even with this 14.2 single-day rally up, it fell 57% after that first rate cut. In fact, investors would have done better if they held off buying stocks, tech or otherwise, until the Fed started raising rates in 2004. All right, so again, it goes back to the chart that, let me get to it. This chart, and it just, whether you're here a little early or here, the writing is on the wall. The Fed would not be cutting 50 basis points, no matter what they say or do. And if you don't, sometimes you just don't think too deep in it. Just study history. History doesn't always repeat, but it often rhymes. And so, but again, you got to, if you short a little too aggressively just because we had a 50 basis point cut and too soon, then you can go underwater quite a bit and even get to your threshold and you stop out right before the turn comes. So I just wanted to kind of paint, this is bigger picture stuff. This does a great job of showing it. There's COVID. 50 basis point cuts do not come when things are hunky-dory, at least not historically. And then one last thing here on this last reply in that same thread. Usually these threads were a little shorter, but there was a lot of good stuff I had to get out there. So, all right, this person replied to my, hey, 50 basis point cut isn't, on face value, and this is what sheep will do. It's just the pattern of the markets have never changed. There's books about this. History again often rhymes. And the same things at the top of a market, everybody's bullish and they want to, spin things as, 50 basis point cuts or whatever is bullish. So this person replied, there are numerous cases when rates were being cut and we got crushed with a bear market. So I tend to agree partially, but the old saying, don't fight the Fed is still in effect. All right, so I replied to that. Good point, and I will play the next rate cut to according how I feel things have progressed at the time. For example, if we had a surprise intermediate cut right now, I'd most likely short into the rally. What people need to understand is why rate cuts usually cause the market to rally. All right, and this is very important, guys. Lower rates mean lower borrowing costs to both businesses and consumers. What's changed recently with the credit crisis is lending standards have dramatically tightened. And I don't see that changing anytime soon. Therefore, what good is another 25 to 50 basis point cut if Joe Blue Collar still can't buy a house or a new car with his 550 beacon score? That's why lower rates aren't going to save us this time around. Only further exacerbate the slide of the dollar, thereby causing hyperinflation in this commodity-dependent global economy of ours. This right here might have been the most prophetic call in history. Oil will be 150 plus barrel, $150 a barrel if the U.S. dollar keeps plummeting. Quite the catch 22 for the Fed. Okay, so I don't know where to begin with this other than the writing was on the one. It's very similar right now. And this point, take this home, because remember the other day I showed you the very clear and significant uptick and accelerating trend in delinquencies, loan delinquencies, both write-offs at banks. They're writing off loans that they deem no longer that they're going to recover, and also those behind 60 and 30 days behind on their consumer debt, credit card and car loan debt. So that's happened. The very next day, the Journal came out with an article that supported what I was saying, and then I saw several others in my news feed. So that's already happening. You don't read about it yet, but the banks will be tightening up credit because people are now tapped out. And so again, what good is this 25 or this 50 basis point cut or the next cut or the next 2 or 3 cuts we're going to do if Joe Blue Collar, again, who's already tapped out because the recession just sucked out every last bit of dispensable income they had, what good are those lower rates going to do? In fact, I spun it as going to be a net negative because the wealthy who've kept this economy going with spending and have a lot of money and buy high-ticket items that have a lot of money in stocks and a lot of money in the home prices, all of a sudden they're watching their money markets where there are a lot of people sitting with $1 million or more in money markets skimming 5% for the last year or so. That's going to go down significantly. That's what goes down immediately when Fed cuts rates, those short-term rates, money market accounts. Those are the shortest-term rates. Not to mention, most of them don't have money in long-term bonds. And if they do, they're already locked in, and now rates are going up, so the value of those long-term bonds are going down due to rising rates. So there's a lot going on here, and this is what you have to realize is when rate cuts work and when they don't, and why they've never staved off a recession. Recessions are a very natural part of the business cycle. They need to happen. The Fed's been trying to prolong or extinguish the business cycle for really now almost 20 years. Okay, now let's talk about that call on crude and why it happened and what may happen going forward. So again, guys, I'm just pulling out old stuff from 25 years ago almost, or what was it, whatever, 20 something, yeah, that is kind of come full circle and relevant today. I'm going to go and guess. And remember, that call was back in the end of 2007, right when the Great Recession was getting going, but very few. There were others. They did movies about it that saw it coming, knew about the housing crisis. My background is I had just walked away from a lucrative career and working as a stockbroker for bank brokerage programs. As an officer for the bank, I was very closely involved working side by side with the commercial lenders, the mortgage lenders, all the bank various business lines. So and right here in ground zero, the housing crisis. So I saw what Michael Burberry and those in the Great Short saw firsthand, living here and not just having a bunch of friends and everybody I knew flipping properties and thinking it was the easiest thing since sliced bread. But again, talking to the mortgage loan officer, said, Randy, I just gave a truck driver a freaking loan for a $500,000 house. The guy makes $50,000 a year. It was a liar loan. They were giving out. They had him to verify income. Anyway, so that was right here, and we had never ever seen crude at $150. So that was that call there, and I gave the reason behind it, that if it continued to see the slide in the dollar, you can see crude peaked right there. The high was right at 150, right, give or take within a percent or so point. That's exactly where I called it to. and that was a tremendous trade, and then turned around and shorted there. And again, why? It was for the fundamental reasons that I cited here. And then if you go in and compare it, we'll go back. So that was the peak on crude was right there in June, end of June. And here, let me pull up, because this chart I don't have a comparison tool on. UUP is the US dollar index. So let's talk a little bit about that, because I'm not just sitting here talking about what happened back in 2007 and 2008 for, just for the sake of it. Here's the dollar index. This was 2008. This is UUP, the dollar ETF. So this was that plunging US dollar that I predicted, and I predicted if they continued to plunge as it did. And you can see right there, the dollar continued to plunge. It bottomed in late March, but it had effectively almost another bottom right about there in July. So this was the cause, coupled with excessive, that they also cited a lot of hedge funds piling in, futures traders buying crude contracts. There was no fundamental reason. And I also stated that the high oil prices, and I've got several of those screenshots posted from around that time, citing that the high oil prices would crush the economy. The consumer was already tapped out. And that was a prediction too, why we were going to have the great financial crisis, and why, I expected a 50+% drop in the stock market back then. And so that happened. And then that's when crude peaked right there, because the dollar started reversing. Now, where are we at now? Well, this is the US dollar index now. What's going on is, we just cut rates. Powell cut rates 50 basis points instead of the usual 25. That caused the dollar to drop. The yen rallying. The Bank of Japan, was it supposed to? Last night they had one coming up, and we know they're not going to hike again because they just blew up the part of the carry trade if they hike again anymore. So that means that the dollar now, and you can see it, and I'll get to JPY in a second. But I wanted to show you this is where we're at. There's a lot of fundamental variables going on. I know I'm still talking. This video is getting long, but one of those is the debt crisis in the U.S. It is unsustainable. I'm not the only one to talk about this. Mainstream media may not. I don't know what's going on there, but we have a problem, and it's only going to get worse. And so the Fed is going to try to, effectively monetize their debt. They're going to, continue to sell new bonds. But if long-term rates get out of control, it's going to be a big problem. And because as older treasuries are coming due, the Treasury Department, and Yellen has been issuing a lot on the short end, but that's a short-term fix. She's been doing that over the last year or so, shifting the bulk of new Treasury issuance as the 30 years and the 10-year Treasuries come due. Instead of issuing that many more 30 and 10 years, they've been shifting it to the shorter term. But that's could be a ticking time bomb here. And so they're hoping rates come down. But if long-term rates continue to go up because of bond vigilantes stop buying our bonds, or for whatever reason, or Powell reignites inflation, like I just talked about a long video yesterday about commodities, and now you get new lower rates. We saw it yesterday after the aftermath, of the Wednesday's rate hike decision. We had an explosive rally yesterday. It was technically induced. We took out the downtrend lines. That was the technical catalyst for it. But from a fundamental perspective, they cited everybody's skittish again. Risk on is back. Bitcoin was flying, tech, everything, you name it. Just about everything was green on the screen. And so it shows you're going to, including commodities. So you're going to have that, to a stronger or lesser degree. You can't have both. So what does the market want here? It wants lower rates for stronger economic growth, but that's going to also lead to inflation, which is going to cause longer term rates to go up, pricing in that longer term economic growth. And then, the Fed is going to continue to have to try to, bring things down. They're going to keep cutting, and I think it's going to have a negative effect. And as I showed you, the cuts aren't going to they're not going to work any better than they did back when they started cutting in 2007 or early '08. It was too late, and it had the opposite effect. So, and so here it is. Technically now, you may not care for my fundamental ramblings. I can tell you right now, here's a nice, clean primary uptrend line on UUP, the dollar index. If it breaks, we're going down here. That'd be a nice, pretty big drop in the dollar. It's really good support. We're at support now, so we could run up there. So this is kind of longer term analysis. When I drop down to a daily chart, Let me put on my lines here. You can see this is probably that same trend line would come in right here that I showed you on the weekly. We have price support here, but if that breaks, and we're coming off this big divergent high right here, right? So we had this bearish rising wedge. The dollar's been moving lower, and as you know, crude has stayed persistently higher. So, this is crude oil. It's been in this range for a while. We're at the higher end of the range. Back a few months ago, I gave you yellow, orange, and red zones, meaning what it would do to the stock market. Right on cue, when we hit my orange zone, the stock market had a big correction there, and crude fell back. Then it did again, and as predicted, that was that 16% drop in NQ we just traded. And crude fell because the stock market fell. But see there, this is the catch-22 the Fed is in. And so now they're getting easy again. So they're buying commodities again. Crude's running back up. And as I showed you, the consumer is already starting to crack. And oil, even though it's off its multi-year highs, it's not far from it. And so with this now, I maintain these zones. They're every tick. Get into the yellow zone. That's where this market starts to become concerned. You'll have taken back this trend line. Get in the orange zone, the market will really start to become concerned. And you get in the red zone, the market's going to freak out. So we're far from there now, or not far from, we're coming up on the yellow zone. And so keep an eye on this. And again, you don't need to fear this. The way to profit from what you expect is going to happen. Right now, like I said, we had a trade on crude recently. I'm out at the moment. We hit T2. We went long here. We milked it up to T2. I don't have a strong opinion or convictions on it near term. The next time I do, I'm going to pull this trend line. I'm going to move that right there. I'll let you know. All right, guys, very long video, but very detailed. Kind of all the little, not all, but a lot of the stuff I'm watching. I'm going to put a trend line here on SOX, the semiconductor ETF sector. Remember, SOX, along with the indexes, broke out above its primary downtrend line off the highs recently, and which had a strong rally as expected. That was a very well-watched technical level, and then it's pulled back. And we are currently back testing both the downtrend line, the primary downtrend line. So I'm going to say this, and I'm going to repeat it 3 times or 2 times. If you're bullish, the semis, this is where you buy. If you don't buy here, I don't know if you didn't buy yesterday on the breakout or here, I don't know where you buy. Or back here when we went long August 5th, or right here when we went long on that second pullback of the trend line. So these were all highlighted. We shorted the semis up there on the bearish engulfing candles. We covered it in reverse here long. We also covered there. We shorted back there on that kickback. This was a breakout. This is a back test. And all I can tell you is objective to buy here, not to short or sell unless this breakout fails. That means we have to come down solidly back below this trend line. And it'll also take out this near-term uptrend line. So there is your objective short entry or objective stop loss for a long that's buying here. And this wouldn't surprise me at all. I can see a little more upside. We're still in below my market top ranges on SPY and QQQ, the top of those ranges. And so I'm pointing out objective levels, how to trade it. And again, based on your outlook, if you think these breakouts are going to fail, you may not opt to go long. You might just sit tight and wait for a breakdown, but pointing out the levels for you. And last but not least, it's just hard for me not to cover the poster child, NVIDIA. My shorting zone still gets rejected off the bottom of there. The stock is very weak compared to everything else. And there's the downtrend line. It broke out above recently. It's back testing currently. So this is where, if the bulls are going to step in and buy, they should. If you been wanting to buy NVIDIA and you didn't buy it here when we covered the short and reversed the long, or here when it hit the primary uptrend line, this is another opportunity for you. So these were our sell points. That was the bearish engulfing that marked the top. There was another bearish engulfing there, but that already doesn't matter because the top was already in. That's irrelevant. We shorted the kickback to the downtrend line. We covered their reverse. We covered in the trend line there again. And now at this point in time, obviously, if I told you a week ago or two, this is my short scale-in zone, I'm not buying this pullback here. I'm sitting tight, but I'm not adding yet. I want to see these breakouts fail. I'm kind of sitting tight on what I do have. and waiting for the breakouts to fail before engaging the market aggressively on the short side. And I'm still actively trading in my swing account long short. I won't even confuse you guys with those trades anymore because they're based off 5, 15, 20-minute charts and swinging the NQs long short. All right, I'm going to stop it here, get the video out to you guys. It's been a long one. But I think I covered everything I wanted to, mixed in a lot of macro stuff, the US dollar, what to look for there, the yen, the euro. I mean, goodness, I don't know what we didn't cover there. I didn't cover the yen and euro, but JPY is coming out, broke out of that bullish falling wedge. And again, this is the dollar going up against the yen right now. The US dollar yen pair breaking out of that downtrend line right there and currently back testing this. So this is an interesting junction too. Let's see where this goes. So we have the bullish falling wedge, the downtrend line right there, and the primary uptrend line, which we're back testing, positive divergence. There's a lot of, and this is major support here. If this thing breaks, that'll be ugly. But like I said, if you want to watch the dollar index, the dollar is not dollar against any one security. It's a dollar against a basket of securities. The two biggest being the yen and the euro being the largest. So watch this primary uptrend line and really, so you don't get whipsawed. The weekly chart's the best way to go. You get a solid breakdown on the weekly, it's going to take the dollar down most likely there. Otherwise, support is support until unless broken. So this says the dollar could rally here right now. Yep, I'll wrap it up here. All right, guys, this has been Randy Finney with Right Side of the Chart.